Welcome to the Cresco Wealthcast. My name is Dimitri. I'm the host of the pod, and I'm also an advisor within the Cresco Wealth Management team. Just want to say a quick thank you to all of you that continue to support and follow the channel. I appreciate you, and of course, welcome back. And if this is your first time to the podcast, thanks for stopping by, and I hope you enjoy. At the Cresco Wealthcast, the inspiration was very simple. I wanted to bring topics that were derived from real conversations, and I wanted to do it in a way that was relevant and relatable to you. And a lot of the conversations and the content that you're going to hear, it's coming from clients, it's family, it's friends, it's just being out and about and having those real conversations. Nonetheless, I hope you enjoy, but before I let you go, just want to let you know you can find us on LinkedIn, Facebook, Instagram, and YouTube. Just search at Cresco Wealth Management. Until then, enjoy the pod. Oh, and by the way, that music you're hearing, that's Pete Ems. He's one half of Small Town DJs, and it was nominated for a Juno Award. He's on the team. No big deal. Okay, and welcome back. Truly appreciate all of you joining us as well. We got something really fun and cool today that we want to talk about. And so from time to time, as you've heard, we'll have conversations that we hear from clients. Today is actually going to be a look in on some of the strategies we use within the portfolio and why we're using them. And it's fun and it's exciting and it's definitely a change. So that's why we wanted to bring it to light in case it brings questions on your end for all you listening. Today we're welcomed with Nick Mersch, the portfolio manager for Purpose Investments. And the topic for today is going to be yield shares. Now we're going to get into that. You don't have to know what it means right now, but Nick, you were in our office the other week as well. Pleasure to do a home and away series here with you.
Yeah, thanks so much for having me. Excited to dive in.
Yeah, it'll be good. And I'm going to mention it anyway. So Brett, who so graciously set this all up for us, he's actually here, but he's not here. But yeah, we're sandbagging him because we can't. And now that we're recording, he can't come in and do anything about it. No, I appreciate it. And thanks for setting this up. And those, again, Purpose, within the investment portfolio, one of the vendor suppliers partners, as we say, that we've done many events together and solutions for clients. And that's really the name of the game, is coming up for solutions. Now, why don't we take through the 411, bring it back, Nick. What are yield shares? What's the motivation behind it? And what is it that you and your team are bringing to the table in the industry?
Yeah, for sure. So when it comes to the why, what we saw here was really a large gap in this marketplace. Because on one end, you had some of these triple levered products that were very complicated from a derivative strategy, and they weren't really fully understood by the street in terms of they were marked on a day-to-day basis. So if you went on a series of bad runs, it can really have that negative impact one way. And then if you look at the other side of the market, there were sort of these very high yielding products, but they didn't really capture enough of that upside. So what we wanted to do was we wanted to go and say, hey, we want to blend that long-term capital appreciation with the income component of it. So we set out a product here, our yield share suite, and they are all these single stock ETFs that mimic the total return profile of the underlying security while generating that monthly yield. And the way that we do this is through owning the underlying directly. We layer in a 50% covered call strategy, add a moderate 25% leverage, and then we also hedge it back on a currency basis. As well, this income is very tax beneficial because it mostly is considered capital gains. So what you end up here is with a product that really combines all these operationally intensive features into one very simple, easy to use, and easy to understand product.
Yeah, no, absolutely. And I like that. Why don't we touch really quick on the leverage and the covered call? What does that mean exactly, and what's going on the underlying strategy, as you mentioned?
Yeah, for sure. So for the covered call component of it, we did a 50% to NAV because we found that really blended a proper mix of appreciating on the upside as well as generating that monthly yield. Now, when we go to write these options, this is what's really proprietary about our strategy. Because we're doing 50% of the NAV, but at any given time, we're underwriting anywhere between 15 to 20 different legs of options across all different maturities at different levels of moneyness. So what we generally try to target is the kind of 2 week to 8 week time frame when it comes to the options legs. But the average maturity is about 30 days, and the average moneyness is about 2.5% out of the money. And we'll write anywhere between at the money and 5% out of the money calls. And these really determine the yield of the product. But what we're able to do here is really when you have periods where volatility is spiking and swinging around drastically, is because we have so many different legs underwritten that we're essentially able to smooth those curves a little bit. And what this does is really mitigate past price dependency, where you get some periods where stocks will run away and then kind of pull back on a midweek basis, especially now with all the volatility that we're seeing. So this really mitigates that.
Yeah. Well, and you really hit my next question, but will extrapolate on it as well, is we're seeing so much volatility in the markets, and it's not even just of recent, let's say the prior few months, but it seems that is a trend and perhaps a continued trend moving forward. And so what you're saying is you're writing these things a little bit more often to help control, to mitigate the risk against the volatility. Is that the primary focus of why we're doing it?
Yeah. So in terms of if you have these options kind of on just sort of 1 month periods, and you have to roll that option as soon as it kind of comes closer to expiry, or you're constantly rolling those options without a more selective window, you're much more exposed in terms of those inter-month swings on the volatility side of it. And what this also does is allow us to look at different parts of the chain, whether we think we want to write a little bit closer to the chain, so the 2 week or 3 week out period, or you want to write a little bit farther. What we're trying to do here is really identify periods where we believe that the implied volatility is mispriced. And that's the way we can be very solid in terms of picking up and generating that extra yield where we think there's a lot of opportunities out there. So I think there's not too much free lunch in the market, and options and the volatility is one way to capture that.
Yeah, no, and that's good. That brings to the next question. What's the selection process? How do you get there? When you're looking at it and saying, okay, this is either, the company that we want to deal with, what are without giving the whole secret sauce either, right? But what are the metrics that you're doing behind the scenes?
Yeah, so in terms of the qualities that we're looking for a lot of these companies, we need very deep options markets. So that's why we picked a lot of these larger cap names and a lot of these more popular securities, because they have very deep and very liquid options market. So that really enables us to be very flexible in terms of what we're looking for. And again, we're looking at kind of these periods where we think the implied volatility is mispriced, but then also we're preferring recently a lot of the front month chain of the options, just because we are able to pick up a little bit more kind of coupon and a little bit more income on the front end. But there are periods in time where we will look more towards kind of longer dated options as well. And what that allows us to do is be a little bit more flexible, because if you have a rigid 50% covered call strategy, as you get closer to key maturity dates, a lot of that could get called away. And that's where you give up too much upside. And what we've really aligned this product suite is these long-term secular growers that are taking advantage of these really big sea changes that are happening in the world. And we wanted to take that approach where you could generate that monthly yield, but at the same time kind of buy and hold these strategies with that long-term appreciation on the upside. So really good combination of blending the two, and being flexible in terms of where we're writing these options allows us to more effectively manage that and more effectively capture a lot of the upside.
Let's tackle the one question when it comes to covered calls leverage that everyone asks, but specifically on the covered call side, is why a product or a solution that has a covered call when you can give up the upside? Can we go into a bit of the pros, cons, and even if you can touch on, Nick, the misconceptions as well?
Yeah, for sure. So if you have one of these products that is a 100% underwritten covered call, what ends up happening is wherever you're writing that covered call, as soon as the stock moves through that strike price, you can think of that as opportunity cost on the upside. And the way that we look at that is that because we're only writing 50% of the NAV and we fully own the underlying, as you move away through those strike prices, that's what you get called away to. But we only lose 50% of that upside cost, opportunity cost, as opposed to the 100% if you were fully underwriting these covered call strategies. And in addition to that, by having different maturities and being able to roll them forward, you're able to more accurately adjust where the new strike prices are if the stock does run away. Then you can write options on the next week, because as soon as the stock gets called away, because we own the underlying itself, we then immediately, as we get called away, buy that back in order to rebalance. And once we buy that back, we're then writing additional options on top of that that are with higher strike prices and generating that yield. And then as that moves, if it moved away again, that's when we would go back and do the same process. So by having a very dynamic and flexible strategy, what we're able to do is just essentially move the goalposts in terms of where we're generating this yield, and then not giving up too much on the opportunity cost front.
Yeah, I like that. And you know, for those listening as well, and maybe for savvy investors that do a lot of their due diligence and research, what are some things that you need to be careful of and things that we come across? And I'm not saying this, let's start, you know, for you to slam any competitors or whatnot, but when it comes to these types of strategies, what should people be weary about that could potentially get them offside? Because one of the things, sorry, and before I let you go on it, is because the question will always be, well, yes, you're generating yield, but the underlying asset is being eroded, so on and so forth. It's not worth it. And then we look at the price. But what are other people doing out there? What is out there, I should say, we should be careful about?
Yeah, I think that some other products that are out there might write those options a little bit closer to the money and print a fancier yield on their brochure. And by doing this, what they're doing is essentially saying, okay, look, we can edge out a little bit more yield, and it might look better on that single piece of paper, and it might bring you comfort to say, okay, this one is 5 or 6% higher in terms of the yield that they're generating. But what you have to think of there is that they're writing much closer to the money. So that means that you're giving up more of that opportunity cost that I had mentioned. What also you might see in the market is people that are might be over distributing. So there could be a component of where they do experience a little bit of NAV grind in terms of they're paying out much more than they're actually earning. And another thing is that if they don't have a whole bunch of different legs of these options, they'll be much more susceptible in terms of when they roll these, what the implied volatility of the underlying is in that week period. So if you have kind of these periods where volatility will have these massive swings, as you're rebalancing the option strategy, if you don't have it very spread out and very much more diversified, then you're going to be very exposed in terms of what implied volatility was for the stock that week. So that's why we like a lot more different legs. And then just to kind of wrap that up, I think that in terms of being wary, you're exactly right, because people will just see a higher coupon on one of these underlying securities, and they say, okay, then that's the one I want because it has a higher yield. But I think that you really have to stress that at the end of the day, the only thing that you eat is total return, and your plate is really just more full on this product.
Yeah, very well said. I appreciate that, Nick, as well. Let's look, what does the future hold in the sense of when we start thinking about, and where this question is derived from is if you look, a lot of your suite is in the tech space, or at least is it fair to say the initial offerings were in the tech space? And I know it's something that you really don't like talking about at all, eh? But what does the future hold when we look at AI, whether it be in these strategies, in the market, usage for yourselves or in the world? What is the future trend? Is it AI, or what are we staring down the barrel of trends that you see on your end?
Yeah, so the way we launch these products is really just the most popular names and the largest market caps because they have the deepest kind of liquidity on them. But we also had the opportunity to go into a little bit more speculative areas of the market that we shied away from, because what we wanted to do was really align this suite with long-term secular trends. And if you look at our suite, it very closely aligns to the entire value chain of artificial intelligence. And I think that anytime you kind of have one of these technologies that's indistinguishable from magic, that's when you can really see this next frontier. And you feel it the first time you use an iPhone, the first time you ride as a passenger in a Tesla on autopilot. And now when you're conversing with ChatGPT, it really feels like this feeling of magic. And what we're seeing now is really the very, very early days of adoption. There was this recent survey out where now 40% of American workers are using artificial intelligence in their workflows, but they're just using it on sort of their personal screen, and it's not really integrated into the workflows themselves. And what we're going to see is this massive explosion of adoption as it really starts to work its way much more into the workflow, and people start using it instead of, okay, I forgot a birthday or an anniversary, let's write me a poem about it. It's going to be, okay, I'm going to optimize my entire workflow and essentially create an AI clone of myself so that I can be more productive and I can shift my sort of brain power away from the tedious tasks and much more towards the tasks that are ultimately much more value generating for the companies. And we're seeing it get replaced from call centers was one of the early hanging fruits. Coding applications was really taking off, legal documentation, and it's really coming in here, and the usage is starting to explode. Now, what happens when that usage starts to explode? You need more and more compute. And so a lot of these guys that we cover are really the arms dealers of the backbone of all the artificial intelligence. And we're seeing what typically happens is that first the value will accrue on kind of the infrastructure layer. Then it moves to the services layer. Then it moves to the application layer. So the infrastructure layer, we're still seeing that being built out. And I think we're very far from peak CapEx, but now we're starting to see it really come through on the services side and then ultimately on the application side as well. So a lot of these products that we have in our suite are very closely related to that. And I think it's one of the most exciting times right now in recent history as we move to this next compute platform, which is terrifying, but equally exciting and tons of opportunities out there.
Yeah, absolutely. And I'll say for those that are listening as well, when you and the team were in the office the other week, even just going down that tangent, I could have sat there for the next couple hours going into it because I share your passion with it as well, right? It's an exciting time. Sometimes when you don't know exactly what's happening is a good thing as well when it comes to innovations, right? Like you say, the first iPhone in our hand, and you're exploring, say, what is this? What is the capabilities? Thank you so much for your time. For today, again, we wanted to really provide a good overview on some of the unique things that you and the team are doing. And I'll end it by saying if anyone has any questions, you're more than welcome to reach out to us. One thing to note as well, if you ever wanted to sit down, and even at Cresco, we'll host breakfast, lunch and learns, forums of this nature that we've done in conjunction. We can accommodate those things as well. There's a lot of really nice things. Actually, I think we're slated to do one come in the fall here as well with one of the offerings. So all the information will be in the link in the bio underneath for this podcast. Any other questions, if it comes to these, you can reach out to Nick, Brett, team, and myself here at Cresco. But I appreciate your time. Looking forward to the next one.
Thanks so much for having me on. Really fun chatting.
Hope you enjoyed the episode, everyone. Thanks for stopping by. Please feel free to leave your comments, or even if you want to let me know topics that you think I should be talking about. You can find us on LinkedIn, Facebook, Instagram, and YouTube. Just search at Cresco Wealth Management. And last but not least, if you want to be up to date with our newsletters, our insights, and even our events that we host throughout the year, you can reach out to me directly. It's pretty simple. You could just go to our website, find me from there, crescowealthmanagement.com. Thanks again, everyone.